On May 15, 2026, the Federal Reserve Bank is resetting, and most Americans are not going to understand what that means until they feel the consequences directly in their paycheck, their mortgage payment, their grocery bill, and their investment portfolio. The most powerful financial institution in the United States is changing leadership for the first time in 8 years. The new chairman coming in has a plan that is fundamentally different from everything the Federal Reserve has done for over a decade. And the last meeting under Jerome Powell just produced the most divided vote inside the Federal Reserve that we have seen in 34 years. Today, I am breaking down every single piece of this, what the 3 major announcements from the Fed actually mean, who Kevin Warsh is and what he intends to do, and most importantly, what all of this means for your money, your cost of living, and your financial future. Welcome to Wealth Analysis Network, the channel that delivers deep, honest, research-backed financial analysis, so every person watching understands what is actually happening in the American financial system before they feel it. If you are new here, subscribe right now, because every single week we bring you the analysis that cuts through the noise and gives you the real picture. Today, we are going inside the Federal Reserve leadership transition, the 3 announcements that matter, the plan Kevin Warsh is bringing with him, and the direct financial consequences for everyday Americans. Let's go through every layer of this analysis right now. Let's start with the 3 major announcements that just came out of the Federal Reserve's April 29th meeting, because each one carries a specific implication for your financial life that most coverage is not connecting clearly enough. The Fed voted 8-4 to hold interest rates steady, producing the most fractured result since 1992, a result that is not just a footnote but a loud signal that the committee is deeply split on where rates should go next. The first announcement is that rates are staying exactly where they are, unchanged in a range of 3.5 to 3.75%. Not cut, not raised. Held in place because the Federal Reserve genuinely does not know with confidence which direction the economy requires right now. The second announcement embedded inside that vote is more alarming than the rate decision itself. 3 members supported the decision to hold rates but did not want any language suggesting the Fed was still leaning toward future rate cuts, citing inflation risks from rising energy prices. 1 member voted for an immediate rate cut. What that tells you is that the Federal Reserve is not just uncertain, it is divided. Some members are saying the economy is slowing and needs lower interest rates to survive. Other members are saying inflation is the primary threat and rates need to stay high or go higher to fight it. These 2 positions are not just different, they are opposite. You cannot simultaneously cut rates to stimulate the economy and raise rates to fight inflation. And the fact that members are pulling in both directions simultaneously tells you everything about how difficult the position the Federal Reserve is actually in right now. The third announcement is the one with the longest-term implications, and that is Jerome Powell stepping down as chairman on May 15th while choosing to remain on the Federal Reserve Board of Governors. Powell is expected to remain on the Board of Governors, something that has not happened since 1948. Which could add a layer of institutional tension as Kevin Warsh settles into the chairman's role. Why does Powell staying matter? Because the chairman only gets 1 vote on monetary policy decisions. The 12-member committee sets rates by majority. Powell remaining as a governor means his influence does not disappear the moment Warsh takes the chair. The internal dynamics of the Federal Reserve just became more complicated than they have been in generations. And those dynamics will directly shape the interest rate environment that determines your mortgage rate, your car loan rate, your credit card rate, and the return on every savings account you hold. Now let us talk about who Kevin Warsh actually is and what his plan genuinely involves, because this is the part that has the most direct impact on your financial life and the part that most people do not fully understand yet. Warsh is a Stanford-based economist and former Fed governor who served from 2006 to 2011 and was Ben Bernanke's right-hand man during the 2008 financial crisis. He has been thinking for years about what the Fed should be doing differently, and he is coming in describing his agenda as regime change at the Federal Reserve. That is not casual language. Regime change means he intends to fundamentally alter how the Fed operates, not just adjust the policy settings within the existing framework. Warsh's plan has two central pillars that work in opposite directions simultaneously, and understanding how they interact is essential to understanding what comes next for the American economy. The first pillar is cutting interest rates. Warsh believes that lower interest rates will stimulate economic activity, making mortgages cheaper, making business loans more accessible, making it less expensive for consumers and companies to borrow and spend. If rates fall meaningfully, more money enters the economy, spending increases, and growth gets a boost. That sounds straightforwardly positive. But here is the complication. We are already dealing with an inflation problem. Warsh would be stepping into an environment where inflation is running closer to 3.26%, and energy markets driven by the conflict in the Middle East are anything but well-behaved. Cutting interest rates into an existing inflation problem risks making that inflation significantly worse, because more money in the economy means higher prices on everything from houses to groceries to energy. This is where Warsh's second pillar comes in, and it is the most consequential and least understood part of his entire plan. The Federal Reserve currently holds over $6 trillion in securities on its balance sheet, assets accumulated through years of quantitative easing. Warsh views the use of the Fed balance sheet as unhelpful in achieving the Fed's dual mandate and intends to reduce it significantly. The theory is that by shrinking the balance sheet, essentially removing money that was previously printed and injected into the financial system, Warsh can offset the inflationary pressure of cutting interest rates. Lower rates stimulate spending. Balance sheet reduction removes money from the system. If these two forces balance perfectly, you get economic stimulus without inflation. That is the theory. But the execution carries serious risks that Warsh himself cannot fully control. Here is why balance sheet reduction is so consequential for ordinary Americans. Since bond prices and yields move in opposite directions, selling trillions of dollars in assets could put upward pressure on long-term interest rates, the rates that directly determine your mortgage costs, corporate borrowing costs, and broader financial conditions, even if the Fed simultaneously lowers the short-term federal funds rate. In plain language, Warsh could cut the rate that banks charge each other overnight while the rate you pay on your 30-year mortgage actually goes up, because mortgage rates track long-term bond yields, not the short-term Fed funds rate. The two-pronged approach could theoretically work exactly as intended, but there is no guarantee, and financial markets are pricing in significant uncertainty about whether it will. There is a third element of Warsh's plan that very few people are talking about, and it may be the most far-reaching of all. Warsh wants to redefine what inflation actually means. He has talked about replacing the specific 2% target with a definition of inflation as a change in prices such that no one is talking about it. A deliberately vague standard that would leave the door open for the Fed to operate with significantly more flexibility on rate decisions. Changing how inflation is defined is not a technical adjustment. It changes the entire framework that financial markets, mortgage lenders, bond investors, and central banks around the world use to price risk and determine interest rates. Every financial product in America, your mortgage, your car loan, your credit card, your savings rate, is ultimately priced around the Federal Reserve's inflation target. Change the target itself, and you change the foundation everything else is built on. Beyond the definition of inflation, Warsh has also said he does not generally believe the Federal Reserve should offer forward guidance as currently practiced, meaning the Fed's regular communications about where it expects rates to go in the future. He has also discussed ending or reducing the regular press conferences that the public and markets currently rely on to understand Fed thinking. These changes matter because forward guidance is how the Federal Reserve manages expectations. Markets price in anticipated policy moves months in advance. Remove forward guidance, and you introduce a new layer of unpredictability into every financial decision that businesses, investors, and consumers make. That unpredictability does not just affect Wall Street. It affects the interest rate on the mortgage you are trying to lock in and the yield on the savings account you are counting on. Now let us bring all of this back to what it means directly for your paycheck, your savings, and your cost of living. The United States currently carries over $39 trillion in national debt. The government is paying more than $1 trillion a year just in interest on that debt, which means approximately 20 cents of every dollar you pay in taxes is going purely toward interest payments that produce no services, no infrastructure, no benefits of any kind. That is the underlying fiscal reality inside which every one of Warsh's policy decisions will play out. And here is the most important truth that most financial coverage glosses over. For consumers, the Warsh era could eventually mean lower mortgage rates and cheaper credit, but if the energy-driven inflation that has been stubborn throughout the post-pandemic period does not ease, those gains could be swallowed by higher prices at the gas pump and the grocery store. The average American is already poorer in real terms than they were before the pandemic, not because they are earning less nominally, but because the inflation that has occurred since 2020 has reduced the purchasing power of every dollar they earn and save faster than wages have grown. If the changes coming on May 15th produce more inflation rather than less, that gap between what your paycheck says and what it actually buys gets wider. That is why this matters, not as an abstract policy debate, as a direct financial consequence for every working American. So here is what you should be doing with this information right now. Understand that the next 6 to 12 months represent a period of elevated monetary uncertainty, unlike anything we have seen in decades. Interest rate direction is genuinely unclear. The Fed's leadership transition introduces policy unpredictability at exactly the moment inflation is running hot and oil prices are elevated due to geopolitical conflict. In that environment, financial preparedness is not optional. It is essential. Maintain a real emergency fund in a high-yield savings account so that economic volatility cannot force you into debt. Understand what you own in your investment portfolio and why, because volatility creates both risk and opportunity, and the people who act from a position of preparation rather than panic are the ones who benefit. And pay close attention to what Warsh actually does, not what he says, because as history consistently shows, the gap between what policymakers promise and what they deliver is where your financial future gets determined. May 15th is not just a leadership transition at the Federal Reserve. It is the beginning of a genuinely new era in American monetary policy, one with real and direct consequences for your mortgage, your savings, your purchasing power, and your investment returns. Stay informed, stay prepared, and never let what you do not understand about the system cost you what you cannot afford to lose. If this analysis gave you a clearer and more complete picture of what is actually happening at the Federal Reserve and what it means for your money, please give this video a like and share it with someone who needs to understand this before May 15th arrives. Subscribe to Wealth Analysis Network if you are not already part of our community, because every single week we bring you the deep, honest, research-backed financial analysis that helps you stay ahead of the system instead of being blindsided by it. Drop a comment below and tell me, what is your biggest question about how the Warsh era at the Fed will affect your financial life? I read every single one. See you in the next video.